Wow. What a crazy last 4 or 5 days it has been in the market. So, I want to try to just come with some calm and some reason here to explain everything that's gone on as far as what does it mean for mortgages? What does it mean for interest rates? Because a lot of people are out there looking to buy. We're in the spring season. So, let's dive into it to see as far as what this means or what has happened over the course of the last 4 or 5 days. So, as most of you know, President Trump implemented these tariffs last week. And as a result, the market has been in a tizzy ever since. We've seen the market go way down. And then, of course, until today, it's rebounded. But when the markets initially sank, what typically happens when you see the stock market and you see the Dow and the Nasdaq, when you see them really go down, or investors are pulling out money and therefore the stock market goes down, what sometimes will happen is they'll take that money and put it into something safer, like bonds, US treasuries and securities. So when this first happened, when the tariffs were first announced, we did see that. We saw people pulling money from the stock market, putting it into bonds. And what that does is now you have more demand for bonds. So it brings the yields down. And that's what mortgage rates are tied to. So we saw the 10-year treasury go somewhere from around 4.3, 4.2, all the way down to 3.8, which was great news. A 50 basis point drop is great for the mortgage industry. This brought rates from the upper sixes, close to 7, down into the mid to lower sixes. So this was great times. We thought, hey, even though the tariffs, I know people are not crazy about that, and it was impacting, people's stocks and 401ks and all of that. We totally get that. But the byproduct of it was at least that we were seeing lower mortgage rates. Well, that was very short lived up until 2 days ago. What had happened is people that were putting money into the bond market, even they got spooked and started pulling money out of there as well. So it was something that we kind of really haven't seen very often, where you have people dumping stocks and people selling off US securities, bonds. So that caused the yields to go back up. And we were being told that a lot of that had to do with some foreign investors. I know Japan was a big investor in our bonds. China is as well. So, of course, they're dumping those. It increased the yield. So now you're sitting here with the stock market, very low or going down, and you have the bond market rising, or the yields rising. So interest rates are going up. So the gains that we received when the tariffs were first announced, in about 48 hours, we literally have given those gains all back in the last 48 hours. Now, there was big news today. Trump announced that he was going to give a 90-day pause to pretty much all countries on tariffs except for China. That has immediately sent the stock market soaring. We're not back to levels that it was, but it's obviously recouped a lot. But the bond market hasn't responded yet. So I think that's going to take a little bit more time. When you have people like pulling out money, and some of that was obviously panic. Some of that was even for margin calls that people had on their investments, because when the investments are sinking and you are borrowing against your investments, you're going to have margin calls. So people needed liquidity, and I think that's why there was a run to the bond market to sell. But now, if we kind of can get on stable footing here, I think you will see people eventually go back into the bond market, but I don't think it's going to happen as quickly as they fleeted the bond market. So we're just going to have to see, but pretty much we're back where we started when it comes to mortgage rates. We're kind of sitting in that upper 6, close to 7% range. But look, I do think there are brighter days ahead. This was kind of a bump in the road when it comes to mortgage rates. People that literally, if you got in within that 24 to 48 hour period, it was a nice kind of little pocket there that you were able to take advantage of. But really, the data moving forward that's going to impact interest rates that we've talked about, it's going to be with the Fed. It's going to have to do with inflation and labor. And we've been saying that really it's going to be labor over inflation. So when we see the unemployment rate tick up, that's when we should hopefully see the Fed react, and we should see lower rates as a result. But listen, this is a moving target. Uh, Data is coming in constantly. If I put out a video 48 hours ago, I'd probably have to scratch it, because things have been so fluid here and things are changing. But just wanted to give you a quick update as far as what's going on in the market and what's going on with mortgage rates. Hope you have a great day.